What are convertible bonds? Convertible bonds are a type of bond issued by corporations that can be converted into shares of the issuing company's stock at the bondholder's discretion. These bonds combine both equity and debt characteristics, offering higher returns than common stock but generally lower than other corporate bonds. Like other bonds, convertible bonds have a specific maturity date, and if the bondholder chooses to convert the bond into equity, it loses its debt properties and becomes an equity instrument. If not converted, the bondholder receives the bond's face value at maturity. Companies issue convertible bonds for two primary reasons. First, they help lower the coupon rate on debt. Investors accept lower coupon rates on convertible bonds because of the potential to convert them into equity. This saves the company money on interest payments. Second, convertible bonds allow companies to delay equity dilution, raising capital without immediately affecting their equity base. Some companies prefer issuing debt securities in the medium term since interest expenses on bonds are tax deductible, and dilution can be controlled as the company's net income and stock prices grow. There are several types of convertible bonds. Vanilla convertible bonds are the most common, allowing investors to convert bonds into shares at a predetermined conversion price upon maturity. Mandatory convertibles require the bondholder to convert into shares at maturity, often at two set prices, one for receiving the par value in shares and another for limiting gains above the par value. Reverse convertibles may be repaid in cash or converted into equity at a set price at maturity. The conversion ratio refers to the number of shares that can be obtained from a single convertible bond. It is also called the conversion premium. The ratio is based on the bond's conversion price. For example, if a bond has a conversion ratio of 30:1 and a par value of 1,000 Australian dollars, this means the bond can be converted into 30 shares of the company's stock. Convertible bonds offer several advantages, including fixed interest payments, tax benefits for issuers, and the ability to delay stock dilution. They also allow companies to raise capital at lower interest rates than regular bonds, as investors are attracted to the possibility of converting bonds into shares. However, there are some drawbacks, such as lower coupon rates compared to regular bonds, the risk of losses for investors if the issuing company performs poorly, and the potential for share dilution in certain situations, which can negatively affect stock prices and earnings per share (EPS).